God forbid that ever comes into public doubt, because if it does, that's a nuclear event. And the bond market, the long-dated U.S. government bond market, is far bigger than the U.S. stock market. Same is true in Japan. We also have troubles in Europe as well. So it's the Western world, including Japan, have major government debt crisis problem. Far bigger event under our feet than ever before in these other market tops, stock market tops. And I think gold knows that. Gold has been around for 3,000 years. It's not a newcomer to reality. I think that's why gold has been going up for a decade, knowing that ultimately this is coming. We're now here. Jamie Dimon said we're facing the crisis. This is I don't think he used the term we use, but it's a nuclear event, and we can't avoid it. And it's not a topic of conversation on financial TV shows. It's barely ever mentioned. Instead, it's earnings of this company or AI or semiconductors, et cetera. You better be watching the financial markets, because they're the time bomb.
In every financial crisis, investors are told to watch the stock market. But what if that's the wrong place to look? According to veteran market analyst Michael Oliver, the real threat isn't a market correction. It's what could happen if confidence in government debt begins to crack. He argues that if both stocks and bonds stop providing safety at the same time, investors could be forced into an entirely different set of assets. And that could reshape global markets faster than most people expect. In this interview, he explains why he believes gold and silver could benefit from that shift, why he thinks the bond market is the real story, and why he calls the next phase of the financial cycle a potential nuclear event. Whether you agree with his outlook or not, his argument raises one question every investor should be asking. What happens if the traditional safe havens stop feeling safe?
Right now, we're in a very unique situation, because not only do I think the stock market is topping, particularly the U.S. market, which is an extreme bubble, by the way. A lot of stock markets are not bubbles. This one is, more so than it's ever been in history, the U.S. stock market. It used to be an alternative would be what? The T-bond market. If you go back and look at the stock market from 2000 to 2002, the dot-com collapse, or 2007 to 2009, the mortgage crisis. T-bonds were a play. They worked as an alternative asset category. So did gold during that span of time. Those two places were the alternative places to be. And investors simply moved their money over there once they realized that's the place to be. I think that's what's going on now, is that we're getting the initial shaking of the market, where smart money is saying, hey, I'm going to start to distribute out of this bloated category and move a little bit more into the alternatives. The big changes occurred, and we know it, because a lot of CIOs of major banks have said, hey, no longer 60-40 rule, stock market, bond market. It's now 60-20-20.
Yeah, like Morgan Stanley bonds. Also advises.
Yeah, Morgan Stanley and others have followed him. Yes, that was half a dozen months ago. He was very wise in that observation. I think the percentages are a little low. That's okay. But at least he acknowledged that gold is a real asset. And I don't think the gold move is over. I think the pullback is intermediate, not long term. And I think that what we're about to see is further toppling of the stock market. And once that becomes bleeding obvious to the average guy and to the central banks, the central banks will print, even though that's not a mandate, because some of the components of the stock market are mandates in effect, banks, et cetera. And we analyze the financial and the banking sector. Technically looks quite vulnerable. But gold is a place to be. And so I think things are changing in a big way. And it's an asset class shift. Public sentiment will shift and finally chase things that it should have chased a while ago.
Michael Oliver believes the biggest story isn't today's headlines. It's where money is quietly moving beneath the surface. His argument is that after years of investors relying on stocks and bonds, institutions are beginning to look elsewhere. If that shift continues, it could mark one of the biggest changes in portfolio strategy in decades. Whether that trend accelerates or not, it's a warning that many investors may be underestimating.
This time around, unlike 2000 to 2002, 2007 to 9, we have a debt crisis involving government debt. We know it's been there in Japan, a crisis where they had the print. That's the phrase the prime minister of Japan used. We're going to print, and they have to save their bonds. The U.S. government bond market is in dire straits as well. We analyze it technically, and we argue that the attempt to base the price of the long-term bonds, 30-year bond futures, for example, since 2022, they've tried to hold a given level, and yields have capped at a given level, but it's not going to hold. We're going to pierce through the bottom of that range, and we're going to push the yields through the top of that range. And that's when you're going to start to get public alarm about, oops, that alternative is not an alternative anymore. Instead, it's the problem, not the alternative. What does that leave you with as an alternative? If the stock market's topping, if the bond market is no longer a viable alternative, as admitted by many CIOs, then that leaves basically one broad category: commodities and gold.
Yeah. And the Fed does seem to be buying treasuries again. At least we see the amount of treasuries they're holding is going up. So wouldn't that be the obvious way for them, and also for the ECB and the other central banks, to basically prop up the markets and make sure that everyone stays calm?
Yeah, well, they can't. It's not a mandate of the Fed. It's unemployment and it's inflation, quote unquote, however they want to define those two terms. And they're always lagged to reality. By the time you get bad unemployment, the stock market's already 20% off its high, et cetera, et cetera. But there's another implicit mandate, and that is we have to defend the state, government debt. God forbid that ever comes into public doubt, because if it does, that's a nuclear event. And the bond market, the long-dated U.S. government bond market, is far bigger than the U.S. stock market. Same is true in Japan. We also have troubles in Europe as well. So it's the Western world, including Japan, have major government debt crisis problem. Far bigger event under our feet than ever before in these other market tops, stock market tops. And I think gold knows that. Gold has been around for 3,000 years. It's not a newcomer to reality. I think that's why gold has been going up for a decade, knowing that ultimately this is coming. We're now here. Jamie Dimon said we're facing the crisis. I don't think he used the term we use, but it's a nuclear event, and we can't avoid it. And it's not a topic of conversation on financial TV shows. It's barely ever mentioned. Instead, it's earnings of this company or AI or semiconductors, et cetera. You better be watching the financial markets, because they're the time bomb.
This is where Michael's thesis becomes much more controversial. Instead of focusing on inflation, tariffs, or geopolitical conflicts, he says the real risk is confidence in government debt itself. His view is that if investors stop treating sovereign bonds as the ultimate safe haven, the financial system could face a very different kind of stress than previous market downturns. That's a major claim, and it's the foundation for everything else he predicts.
We gave our last buy signals on gold and silver, major long-term investment grade buy signals, not get in, get out type signals. Were in March of 24, we said, okay, the range-bound situation in gold and silver is ending in the minors. Time to go long, March of 24. We were focused on silver primarily then. It was about $25. Okay. Next phase was in June of 25. Silver then was approaching 35, because we think silver is going to outperform gold in the coming year or so. And then our final signal was at $56 in November of last year. And if you think about the drop we just had, and we thought there would be a very dramatic upside in the metals. And I don't mean what we saw up into January. That wasn't the dramatic upside. I think we're going to go a lot higher.
Yeah, like 300 to 500 for silver.
300 to 500 silver is probably minimal. And gold's well over 8,000. I'll remind me to come back to that issue, the 8,000. Yep. But the drop, we expected a sharp drop in the middle of this massive move that we expect to see. And we got one, but it came faster than we thought it would occur and a bit earlier than we thought. We thought it might be March or April before it happened. It happened in the last day of January. In fact, the break was really a day and a half. Most of the drop was a day and a half. On the other side of that upturn, I think gold is going to go well past 8,000. Why 8,000? The prior bull moves in gold, since it was legalized, went from the 1976 corrective low, it was legalized in 75, had a drop to 103 in 76. From that low, you went to 850 by 1980. Eightfold move. Then you made a low, 2001 and 2, at about $260, $255. Next high was 1920, another eightfold move, different spans of time. Our low was 1,050 in 2015, the last major bear low. Eightfold move says 8,500 or so.
Interesting. That neatly aligns also with Deutsche Bank's forecast that gold could go to that same level in a few years from now.
And Morgan Stanley came up with, JP Morgan came up with 9,200, I think. But we argue that one, getting there will be very rapid, but two, these other events that are fundamentally major, like the government bond crisis, will move to the fore instead of being hardly chatted about. And the whole public perception and government perception of what's going on and how dangerous it is will change all assumptions about what central banks are going to do. And there's only one thing they can do. They cannot let the house burn. Exactly. They have to print. They have to buy those bonds. And that means print the money, meaning accelerate the monetary growth. And we all know that that's what gold lives on.
These are some of the boldest forecasts in the entire interview. Michael believes future monetary expansion could drive gold and silver significantly higher, especially if governments respond to financial stress with additional liquidity. These are forward-looking opinions, not guarantees, but they show just how strongly he believes the current financial cycle differs from previous ones.
I think what's going to happen is that gold and silver will ultimately become a panic point for the public where they will rush into it because it literally becomes the only place to be. Now, basic commodities will also come into play here. I think they're an investment grade situation. I don't think they're meteoric, but I think they're an investment grade place to be because they're vastly undervalued. And I think the money will move there. But what happens right now, we don't have extreme emotion in the markets, in the stock market, for example. Right now, anybody who has a retirement account at least is smiling, saying, well, my retirement account's up from a year ago. That's the only thing he's got to smile about. It's not his cost of living. It's not his mortgage. It's not the fact that he's past due on his credit cards like nobody's been since 2008, whatever. It's that his stock market's up. But if you take that away from him, you interject emotion into the public, because then they have no sense of an anchor or something to grab onto. Then they're desperation. So you go from calm to emotion. Stock market will help precipitate that. The government bond situation will create even more panic, because if that's not a safe place to be, then the whole world has been turned upside down. Meaning concepts that we've had for 100 plus years, institutions we've had like the central bank, Federal Reserve, and so forth, will come into question in terms of, gee, do those really work? Or are those creators of dysfunction? You look back at the history of the Fed, they create boom-bust cycles. Monetary expansion, stock market goes up, then suddenly you get excess, stock market breaks, the Fed panics again, prints more money. It's like a boom-bust cycle. And I think there's a growing awareness of that among academicians. But what will really bring it to the front is when you get into a crisis mode and markets hurt people. And that's when suddenly any talk about what's going to happen will go tabula rasa. I don't know, but I know a lot of concepts and institutions will probably be just simply puked out. They don't work. And therefore, to some extent, it's a nuclear event. Mankind will be looking for alternatives.
One of the most interesting parts of Michael's argument isn't about charts. It's about human psychology. He believes investors rarely move before crisis. Instead, they react after confidence begins to break down. If that pattern repeats, the biggest moves into defensive assets may happen only after fear replaces optimism.
What if that happened globally and was provoked by a crisis-type situation, financial crisis, that isn't just here or there, but it's everywhere, especially Europe, especially US, Japan? That will provoke ripping the tablecloth off. And, let's find something new. And I'm not going to predict what that is, but I think that's the kind of event that could come quickly once certain markets start to implode. One, the bond market is on the edge of creating a panic. And two, if the stock market rolls over not much further than it is now, like another 7-8%, you're going to start to see real, more rapid degradation there in that asset, which will create the emotion.
And would you expect that this year already?
Yeah.
Or?
Yep.
Yeah.
I expect it this year, I think probably in the third quarter, fourth quarter. We're in the third quarter, excuse me. Especially noticeable as we get into the fourth quarter. And I think that's considered. You as an investor have certain broad places to be. Let's call it stock market, government debt, commodities, and gold. Okay? Real estate's in question, by the way, right now, very much so. But if all of a sudden we know that bonds aren't working, and the stock market starts to fail, then what's your option? Especially if it is accompanied by pain. That's when gold can go ballistic, literally parabolic type action. And especially silver and the miners, I think, would do so more than gold.
Whether you agree with Michael Oliver or not, his message is ultimately about confidence. He believes the next major turning point won't be driven by a single headline, but by a broader shift in how investors view risk, debt, and traditional safe havens. If he's right, the next few years could look very different from the last decade. Michael Oliver's outlook is one of the most bearish warnings we've heard about the global financial system, centered on government debt, capital flows, and precious metals. Time will tell whether his predictions play out, but understanding different perspectives is an important part of making informed investment decisions. If you found this analysis valuable, subscribe for more interviews and market breakdowns, and let us know in the comments. Do you think the biggest financial risk today is the stock market, government debt, or something else?